Vinod Karki, Senior VP Equity Research at ICICI Securities, joins in for a completely different conversation, but I'm tempted to ask Vinod a thing or two on consumption right now because we just spoke to a few consumer companies. Vinod, great having you. Thanks for joining in. I hope all is well. Neeraj here. I want to start off, I don't know if you got a chance to hear a little bit of the conversation that we were having in Metro as well. But on retail, Vinod, what's happening here? The trends are changing. There is quick commerce coming in, eating away at some of the pie for the FMCG or rather the staple retailers, if you will. But newer formats, the way Trent is coming out, they're doing wonders. Metro Brands has not done very well in the last 3-4 quarters, but confidence of 15 to 18% growth for the next 5 years. How do you look at this space?
Yeah. Hi, Neeraj. Thanks. So I think this has been a hallmark for some time now, I guess, because look at a lot of categories of retail. Eating out, going to restaurants, having pizzas, burgers. I don't think as a overall consumption basket, if you were to take the overall aggregate demand for these kind of consumption categories, things would have weakened. But as you rightly said, sir, there are so many channels. For example, earlier you used to have one retail guy selling burgers. Now there are so many. You're spoiled for choices across the board. Cloud kitchens and other brands and foreign brands all coming in and chipping away. So I think that's the thing. From an aggregate consumption, discretionary consumption perspective, I don't think there are issues at the macro level. It's more to do with a lot of players getting in, new channels evolving, and the traditional channels getting chipped away in terms of their market share. So I think that is the thing. But overall, from a overall consumption perspective, things are looking a little worrisome in the sense there was this the expectation that rural consumption will pick up sharply this year. But I think what has happened for rural consumption is that the weather patterns have been pretty in a disarray, and their further expectation that it will continue to be so. We saw rains in October, which is a peak harvest season. Basically, crops are standing, and then they get impact. There's a damage to the crops. Inflation goes up. We're seeing the vegetable prices really shoot up. And at the same time, when I look at the rural wages, they are trending at 5-ish kind of number, while CPI rural is almost 6%. So we are looking at a situation where wage growth may be lower than the inflation. So real income is an issue, So, so that's an overall picture. But there is a silver lining that the monsoon overall has been good. So which means that the reservoir levels are at 87% of capacity. So if you don't have a severe winter as that is what is expected, the Rabi output might look good. So that may be a silver lining, but we'll have to watch out for these weather patterns. If they subside and we don't have a very severe winter and these unseasonal rains stop, I think we are in for some pickup later in the year, next year, basically towards the end of the year, financial year.
Okay. The other aspect is the conversation that we are having earlier with Amber Enterprises and EMS, and that space seems to be showing some really strong growth even now. Amber had a great quarter. Dixon today expected to come out with a good quarter. A couple of the smaller ones have delivered as well. This space largely growing, at times goes through a bit of a flux in terms of valuations, but growth can't be questioned. My question to you is really, at a point of time when the market is clearly differentiating between paying top valuations to high growth companies versus punishing companies which may have been perceived to be high growth but are missing. What is your view on the EMS space?
Yeah, you have already said what I think about it. It's basically the growth outlook is not questioned. I mean, you can't question the long-term growth outlook for this sector. It will continue to grow, but the point is if the market has kind of priced in the higher growth early, so there'll be a phase of some kind of a consolidation before the valuations look. You'll never get a very cheap, attractive valuations. But where the PEG ratio, when you look at these high growth companies, the only thing you can do is, let's say the company is growing at 30%, and the PE is around 40 times. So so it is like 1 point something. So that becomes a benchmark. So if you are like a 50 PE kind of a stock, getting 30-35% growth, or 25-30% also, you're still within the range. But if the growth slumps to, let's say, closer to the GDP, which is already trending at 12%, and you are at 50-60p, then it becomes difficult. And if the expectation was 20-30% and it comes to 10-12%, I know that, so that will be the key. So earnings downgrade, growth revisions, that will be the key. But the story, in fact, remains till it is broken, I guess, for this sector.
Okay. Vinod, a lot of question marks over the capex intensity, and we know that the government capex slacked in the second quarter or the first half, if you will. Elections, rainfall, what have you. Almost every number points to that. I don't know if you think about it differently. My question to you is, do you expect a pickup here? And could it revive the fortunes for the capex-linked sectors?
So we specifically pointed out this in one of our reports. We said that if you look at this anomaly of general elections, same thing happened in 2019. This government has this habit of doing front loading of capex, because when the Feb you announce the budget, then in the Q1, that's the fastest capital outlay quarter, because then monsoon sets in and slows down, and then it starts to pick up again in Q3. But by then the opportunity slows down to really. So, but this year, like it happened in 2019, there was a YOY, because in non-election years it has been front loaded, and in this quarter, because of elections, it fell significantly. And in FY20, when the 2019 elections happened, the capex was back-ended rather than front-ended in that year. We expect that to happen exactly like that in this year, because what can scale back the government's capex plan, which is around 11 trillion, which means almost more than 90,000 crore plus of capex run rate per month, and we are trending at around 60,000 crores. So just to make up the trend from here on might look very strong, but that is statistical. But anyways, because it was a slowdown period in the first half, people had started to think that, okay, this is slowing down. I don't think that's the case if you go by past precedents. So we expect a surprisingly, and not surprisingly, I mean statistically high number in the second half. Not only for government capex, because you know that when the elections are around, the private sector is also hesitant in terms of new capital outlay. They have a wait and watch approach. So I think second half will be a period where you might see some flare in the capex side of the economy picking up.
Okay, okay, Vinod, let me try and understand. There is the last 1 month. We've seen the first whiff of a real corrective move, if you will, in quite some time now, at least at the broader end of the spectrum. Portfolios have hurt, are hurting, if you will. Is this a dip that you would have been waiting for? Would you deploy gunpowder? Would you recommend deploying gunpowder here? Or would you believe there might be slightly better times to deploy that gunpowder? In that, could there be more correction? Large cap, mid cap, small cap, where have you?
Yeah, so I think from a large cap, small cap perspective, we have been saying for some time now that the broader market, small caps and all, I think the risk reward was not looking good at all, despite they are expected to have higher growth. But from a relative valuation perspective, they were not looking, what I should say, the right valuations. So some more correction in small caps would be desirable. We don't know whether that will happen or not. But if you just do a sensitivity in this, and see, post COVID, we are in a some kind, not some kind, we are in a bull market. The Nifty is almost, I think, 3 times and above. The only major correction we had was in 2022, when the Nifty slid by around 15%. So just doing a sensitivity of the amount of fundamental factors and how much the market corrects, you can assume that, I mean, the 15% was in light of an environment where there was a nuclear brinkmanship, Russia attacking Ukraine, and that kind of a thing. And then it was exactly the period when the Fed, from almost near zero, the interest rates went way above 3-4%, and there was a commodity spike. I mean, oil went above 100, and across the board, commodities prices went up. We also saw very good profit growth from commodity companies that year. So I think if you look at just the sensitivity, the current scenario doesn't look to be that spectacular. Neither we are having a geopolitical crisis of that order magnitude. Neither we are having the vulnerability on the external sector where the crude goes beyond 100, commodity prices spike, and we have an issue. So I think from that perspective, we have corrected, I think, 5, 6, 7% odd on the index level across large, mid, small. More correction can be warranted from small cap just because their relative valuations are unattractive. But from a large cap perspective, just going by the sensitivity in the kind of period where we are, where the large selling by FIIs get absorbed by DIIs, I think 15% was kind of peak correction that we saw in this environment. So I would assume the correction should be lower than that, given the magnitude of the fundamental impacts that we are seeing.
Got it. Okay. Okay, well, afraid we are out of time completely on this show, but Vinod Karki, take a moment to thank you for joining in today, and to you and yours, festive greetings. Have a great Diwali.
You too, Neeraj. Have a great Diwali. Have a great year.
Thank you so much. Thank you so much.